The next speaker today is Samuel Mugel. Samuel holds degrees in physics and also a PhD in mathematics. He is a computational physicist, and he is also the co-founder and CTO of Multiverse Computing. Sorry. Welcome to Quantum Summit, Samuel. It's great to have you here and to finally see you and meet you after just exchanging emails before. I'm looking forward to an interesting talk from you, and I think I just hand over the stage to you hereby.
Thanks so much for the kind introduction. Great. So, yeah, like you said, I'm Sam Mugel. I'm the CTO of Multiverse Computing. We're a Spanish-Canadian startup that develops fintech programs using quantum computing. I'm actually based in Canada, so it's very early for me in the morning. So please be patient with me if I lose my words. Great. So to tell you a little bit about the talk, I'll tell you a little bit about who we are. I actually dropped the parts about main players in finance. I'll tell you about our work in capital markets. These are some really interesting, really exciting early results that we obtained with our toolbox. And then I'll tell you a little bit about this toolbox for quantum for finance that we're building. And then I'll conclude. So this is our team currently. We're distributed between San Sebastian in Spain and Toronto. So over here, you've got the four founders. I'm here with the crazy hair in the middle. We've got three people on the business team, and then we've got a whole bunch of technicians. Most of them have PhDs. We're actually also hiring at the moment. So if you're looking for a job and you've got a background in physics, shoot me an email. My email's on this slideshow. These are some of the customers that we've been working with, public now. So BBVA is the 47th biggest bank in the world. And we did an extremely interesting work in capital markets with them. The work that I'll be presenting today, we did in collaboration with Bankia. So this is the world's 100th biggest fund, so it's also a major European bank. And this was building upon the project we did in collaboration with BBVA. And finally, we've also got a project on the go with Hacienda, the Spanish tax agency. I won't be talking about this today, but I'm really happy to take any questions about that later on. And also Multiverse, we were featured recently, really excited to be featured by the Boston Consulting Group as one of the major startups that's doing, one of the players that's doing really interesting work in quantum computing for finance. Cool. So to tell you a little bit about the history of Multiverse, we started out as a not-for-profit organization, and we were quite well connected in Spain through one of my co-founders. And we had all these people come and ask us, when's quantum computing going to be important? When's the right time to invest? What's the potential? And so we set out to answer this question for the finance market, and went and wrote a review of, we systematically looked at every single quantum algorithm that there is out there. There's a lot, but there's a finite amount of them. And we identified where they could be applied in finance and where they could produce an advantage, basically, where they could be disruptive. And so we wrote a review that was published in 2019. You'll have a whole list of interesting references at the end of this presentation. So the review will be there. And we identified essentially 3 big areas within finance that quantum computing could be disruptive for. So this included capital markets, and this is what we'll be talking about today, specifically portfolio optimization. And there's a whole load of related problems that are extremely high value, extremely interesting, related to portfolio optimization. There's also a whole credit and risk verticals. These are typically solved using Monte Carlo simulations, and there's extremely exciting algorithms in quantum computing for tackling this type of problem. And finally, we identified fraud detection type verticals, so things like credit card fraud, anti-money laundering, tax fraud detection. These are typically you'd use machine learning type of algorithms, and there again, there's a whole zoo of quantum algorithms to tackle these. So great. Today we'll be talking about portfolio optimization. Okay, so the specific problem that we're tackling is if my investor wants to take a given level of risk, what is the investment portfolio that will provide me the highest returns? This problem is solved by optimizing this cost function that's written over here, and I've written it to look a little bit quantum. And this is the equation from modern portfolio theory. The interesting thing that's a well-known fact is that the what's called optimal portfolio, the efficient portfolios, are going to approach this efficient frontier over here. So you have all your possible portfolios will basically form a clump of dots in risk versus return space, and then the efficient frontier here is where all your efficient portfolios are going to lie. The problem we're tackling is dynamic portfolio optimization. So here, we're not only looking at buying shares of Apple and holding them, we're actually looking at what is the right sequence of buys and sells to optimize risk versus profit. And let me run you through quickly the different terms in this equation. Mu is the forecast returns of my assets. Omega t are my asset holdings at time t. So this is what shares I'm in my portfolio at time t. Then the second term embodies risk, and gamma simply tunes what level of risk I want to take. And this third term embodies transaction costs. And this is what makes this problem extremely difficult. Essentially, this term is going to mean that your optimal portfolio today is going to be highly dependent on your history of investments to date. So this is really the term that makes this problem intractable. Maybe what I should say as well is that there's some extremely interesting analytic approaches that exist where you're going to take certain assumptions about your risk profile. So if I assume, for instance, that my portfolio values are Gaussian distributed, then this is an approximation that's going to lead to a closed form solution. Maybe one thing that I should say about this approximation is that it's very widely used, and it causes you to take some to make some approximations about the correlations between your asset. And this is, for instance, the approximation that led to the 2008 financial crash. People were assuming that asset values were uncorrelated, and and this had really disastrous consequences for the economy. So here we're going to set up to not make that assumption, and to characterize risk exactly. And this makes this problem very, very difficult. What our big realization is that this equation over here can essentially be mapped to a cubo, and this allows us to solve this problem on D-Wave and also using tensor networks algorithms. And if I have a bit of time, I'll touch on that later, because this is a field that we're very active in. Great, over to the results. So here we optimized a portfolio. This was a 7-asset portfolio, and we introduced certain constraints that made the problem quite difficult. But especially, we were looking at a 1-year period with daily transactions. So there's a phenomenal amount of the space that we're optimizing is huge. There were 10 to the 1300 possible portfolios in this space, which is many times bigger than the number of atoms in the visible universe. So this problem is really has no nice mathematical structure to hold on to, and it's completely impossible to solve using classical supercomputers. And however, on D-Wave, we were, okay, so maybe I should start here. The blue dots over here, so here I've got my profit versus risk axis, and the blue dots over here are just randomly selected investment trajectories. As you can see, these tend to be between maybe 9% risk and 18 or 17% risk, and approximately between 20% and minus 20% profit over the entire year. And then these color dots were the ones that we were able to obtain using D-Wave. And as you can see, these tend to approach much closer the efficient frontier. So these are different risk profiles. So for instance, for this dot, for this red dot, we said, what's the portfolio with the highest returns that we can find that is under 10% risk? So this would be suitable for an investor that wants to take up to a 10% risk on their portfolio. And then for any given portfolio, we'd be able to supply the trajectory that would lead to these returns. So for instance, this is my 15% risk package portfolio. And as you can see, this is the investment trajectory that would give me 60% return. So this would, for instance, call me on the 1st of June 2019, I invest 1/5 of my available cash into Fidelity Global, 1/5 in Amundi, 2/5 in Nordea One, and 1/5 in Franklin India. And so we selected these particular 7 assets because they were of particular interest to our clients. Great, I've got a couple of minutes left. So let me tell you rapidly about tensor networks as well. So we're very active in tensor networks. These are a class of quantum-inspired algorithms that come to us from deep physics. Essentially, it's applying ideas from quantum information theory to reduce the size of the space that we want to explore. So essentially, this would be the equivalent of if you're searching a mountain range for the lowest point, then we'd use quantum information theory to say, let's not explore any of the peaks. We're only going to focus on the valleys. It's interesting because this is really a situation where you can take ideas that popped up in quantum computing and in the quantum world, and then apply them to better classical computations. And there's some really impressive things you can do with this. And what we found is that these tend to converge to better solutions than D-Wave, but take a lot more time. So the comparison was 170 seconds on D-Wave versus an entire day of computation on using tensor networks. So suitable in different situations. Finally, let me tell you a little bit about the toolbox we're building. This is a toolbox to tackle all or many of the different verticals that I presented on that slide earlier. We're aiming to be quantum agnostic, so running on superconducting hardware, but also photonic ion traps, neutral atoms. And really, our aim is to be able to, if a client comes to us with a problem, to be able to provide like the best answer the technology can provide. So it's not about doing quantum, it's really about like solving the problem in the best ways possible. And like I said, we're very active in quantum-inspired methods as well. And so our toolbox Singularity will live in the cloud, and will be accessed through an API by our clients, for instance, like quants and banks. And then from the cloud, we'll have access to different quantum computers or GPU farms. Great, and to conclude, so we're a company that helps financial institutions to explore quantum capabilities and benefits. There's plenty of short-term gains that you can obtain today from applying quantum computing to finance. The results I presented were from optimizing an investment portfolio spanning 1 year and a portfolio of 7 assets. And we did this using D-Wave and tensor networks. The best portfolio we obtained was 60% return on investment for a 15% risk. One thing I forgot to say, very proud of this result, because for the same period, our client had, for the same level of risk, a 20% return on investment. So that was great. And then I presented Singularity, that's a cloud toolbox for intractable problems in finance. Here are a bunch of references that might be of interest. Don't hesitate to message me to ask for the slides or the organizers. And that's it. Thanks for listening. Are there any questions?
Well, thanks a lot, Samuel. That was very refreshing. Thank you for this insight into the financial industry and the benefits that can be had here from quantum computing. There are indeed a few questions, but let me start with a question myself in this case. I'm interested in your personal opinion. Do you think, with the progress in quantum computing currently and in the next few years, who will profit first here in the finance industry? Will it be the big banks because they have the money to invest here and get maybe smaller companies like yours to work for them? Or will it be startups who will use it for their own benefit, so to say, in investment, and will challenge the big banks on this?
Wow, that's a great question. Okay, so it's actually a question that's come up a bunch of times. We've said internally, like, we're developing all these great investment tools. How about we just ditch the banks and go and start a hedge fund? That's a good question. I think I'd say the banks, just from seeing the environment, I think the banks are actually quite ahead of the curve relative to like insurance companies and governments and hedge funds, actually, or pension funds. I think the banks are more open to innovating this way. I would say the banks rather than the startups. I'm not sure startups would have the bandwidth right now to start their own fund or something like that.
Okay, thank you for this.
I'd love to be proof drunk.
Yeah, of course. There's a few more questions. For the results that you've showed, it was asked, are those actually theoretical results?
No. So these results were, okay, so we didn't invest in this. However, we did obtain this using real data that was provided by a client. And then it's very easy afterwards to go back and check whether your portfolio actually obtained the predicted metrics or not.
Okay. There's another question. It's like how to connect quantum computers at digital systems and sensors, or would it be better to connect it to fast analog systems?
Right. Okay, so is the question is it better to run computations on digital quantum computers or analog quantum computers? Or is it...
I'm not sure I'm getting the question exactly to here, how it's exactly meant. But maybe you can discuss this further in the speaker's corner then, and then
Absolutely.
You will be there available for the next 15 minutes, of course. So I invite all the interested participants who want to engage in further discussions or questions to please join you in the speaker's corner in the Meet the Speaker section via the link provided. Thank you once again for being with us, Samuel. Good luck for the further efforts in and with your company. And goodbye here from Stage Bob.